Welcome back to Talking Business as usual. All right, today we are diving deep into a company that's both an absolute titan of industry and honestly one of the most complex businesses out there, Brookfield Corporation, ticker BN. It's a name that has some of the world's smartest investors talking, and we're about to figure out exactly why.
So why all the buzz right now? Well, here's the deal. The legendary investor Bill Ackman has made a massive, and I mean massive, public bet on this company. He's convinced he sees something that the rest of the market is just completely missing. So the big question is, what is it?
And look, this isn't just some small, speculative position. We are talking about an incredible level of conviction here. As of his last filing, Brookfield makes up almost a fifth of his entire Pershing Square portfolio. That's his second largest holding. You know, when a manager like Ackman puts that much skin in the game, you gotta sit up and pay attention.
So here's our game plan for today. We're going to peel this onion layer by layer. We'll start with Ackman's big bet, then we'll break down Brookfield's three money-making engines. We're also going to uncover their double-dip secret weapon and a huge bonus that's hiding in plain sight. And then, to keep things balanced, we'll dig into the bear case before we wrap it all up. And hey, if you enjoy deep dives like this one, do me a quick favor and hit that follow button and give us a 5-star rating. It really, truly helps us bring you more explainers just like this.
Okay, so what's Ackman's core idea here? It's actually pretty simple. He believes Brookfield is trading for way less than what its assets are actually worth. He sees this cash-gushing machine that the market just doesn't understand. And lately, he's been calling it a critical picks and shovels play for the whole AI revolution, because they own the exact stuff, you know, the data centers and the power grids that AI needs to even exist.
So, how does this giant actually work? The best way to get your head around it is to think of Brookfield as this massive compounding machine that has three separate but totally interconnected engines. If you can understand these three parts, you can understand the whole company. Now, here's where it gets really interesting. Brookfield doesn't really focus on normal profits. They have their own metric called Distributable Earnings, or DE. Just think of it as the cold, hard cash they actually have left over to spend. And you can see here, the asset management arm is the big kahuna, kicking in 45%, with the other two making up the rest. So let's put some meat on these bones. First up, you've got the asset manager. This thing is a fee-generating beast, managing over $1 trillion for big players like pension funds. Then there's Wealth Solutions. That's basically their insurance business, and it creates this giant pool of cash called float that they get to invest. And last but not least, the operating businesses. These are the real, tangible things, the dams, data centers, and pipelines that literally make the world go round. Okay, now let's focus in on what might be the most powerful, the most clever part of this whole operation, that Wealth Solutions engine. This is where they have a strategy that lets them get paid twice on the exact same dollar. It's a concept we're calling the double dip machine. But first, you have to get this one key idea: insurance float. See, when someone buys an annuity, they give an insurance company a big chunk of cash, but the insurer doesn't have to pay it back for years, sometimes decades. Well, that giant pile of money they're sitting on in the meantime, that's the float, and they get to invest it all for their own profit. For Brookfield, this float is over $140 billion of pure investment firepower. It's just staggering. Let me give you a super simple analogy to explain this double dip thing. Imagine you own a really nice steakhouse. That's the insurance part of the business. But you also own the cattle farm that supplies all the beef. That's the asset manager. So a customer comes in and pays you $100 for a steak dinner. Now, you need to buy the beef, right? But instead of buying it from some other farm, you buy it from your own farm. So boom, dip number one, your steakhouse makes a profit on the dinner. And boom, dip number two, your farm makes a profit selling you the beef. You get paid twice on the same transaction. It's brilliant. But wait, there's more. Beyond all the day-to-day profits, there's another layer of value here that the bulls think is about to absolutely explode. It's called carried interest. You can think of it as a massive performance bonus that Brookfield gets from making great investments. And they are right at a huge turning point.
Now, the really crucial thing here is that Brookfield's carry is considered incredibly safe. And that's because they use what's called a European waterfall structure. See, unlike a lot of their competitors who take a bonus after every single good deal, Brookfield doesn't take a dime in performance fees until they've paid back all of their clients' original investment first. It's way more disciplined, takes a little longer, but once that cash starts to flow, it's pretty much a sure thing.
And this chart right here shows you the payoff for all that patience.
Over the last decade, Brookfield brought in about $4 billion in carry. Not bad, but because all these funds they started 5, 6, 7 years ago were finally maturing, they expect to bring in a staggering $25 billion over the next 10 years. We are literally going from a $4 billion era to a $25 billion one. It's a huge shift.
Now, I know what you're thinking. This all sounds almost too good to be true. And if it's so great, why isn't every single person on Wall Street piling into this stock? Well, it's time to flip the coin and look at the bear case, because there are some very real risks that keep a lot of smart investors away.
So let's just ask the question directly. What could go wrong here? Understanding the arguments against Brookfield is every bit as important as understanding the bull case.
When you talk to people who don't like the stock, you hear the same things over and over. Number one, complexity. It's just a black box, impossible to really follow. Number two is the leverage. I mean, Brookfield uses hundreds of billions in debt, and in a world with high interest rates, that makes people nervous. Third, some folks just don't believe the values Brookfield puts on its private assets, especially things like office buildings. And finally, you know that double dip model we just talked about? Well, that can cut both ways. It also creates concentration risk. If one part of the business gets hit, it hurts the whole company twice.
Of course, Brookfield has an answer for all of this. They'd argue they've built in some serious safety valves. For one, about 85% of their insurance annuities have these long lockup periods with big penalties if you pull your money out early. That basically prevents a run on the bank. They also keep a giant $60 billion cushion of cash in bonds just in case. And critically, most of their debt is what's called non-recourse. That means if one single asset goes bad, the lenders can't come after the parent company. It walls off the risk.
So this brings us to the big finale. We've seen the incredibly powerful bull case, and we've looked at the very serious risks in the bear case. It really all boils down to one central question, one core tension.
And you know, this quote from CEO Bruce Flatt perfectly captures the entire philosophy of the company. They are playing the long game, period. They believe that over decades, the raw power of compounding the cash flows from all these real-world assets will just overwhelm any short-term worries about complexity or market swings.
And that leaves us with the ultimate question for anyone looking at this company. Is Brookfield a once-in-a-generation compounding machine that's just misunderstood and hiding in plain sight? Or is it a complex, over-leveraged black box where the risks are actually being underestimated? The answer to that question, well, that's the entire investment thesis right there.
And as always, a quick reminder that none of this is financial advice. You absolutely have to do your own research and due diligence before making any investment decisions. And hey, one last thing. If you enjoyed this breakdown and found it useful, a quick follow and a 5-star rating goes a really long way. It helps us a ton in making more explainers just like this one.
Thanks so much for tuning in. We'll see you next time.